This is great. Hello, everybody. Welcome to the OpenWater webinar on Get Your Wings, How to Be an Angel Investor. We have with us today, we are so lucky. We have with us today Ali Moiz, who is just an investor, startup guy, just like long history. I'll let him sort of explain a little bit more about what he does. And Paul Walborsky, who is not only an angel investor, but also a co-founder of OpenWater. So one of the reasons we are here today. Thank you, gentlemen, for being here today. Ali, I'm going to start with you real quick, which is let's just set let's baseline this here real quick. What is angel investing? I think because it used to, like, if I think back to the 90s, or I think back to the early 2000s, it was one thing, and I feel like it's kind of grown and evolved. So can you give us sort of a definition of angel investing as you see it?
Yeah, and thank you, Chris, for having me here. Excited to be here. Great community, and thank you, Paul. Angel investing very simply is investing in startups very early on when VCs typically will not. So usually you're the first check in or one of the first checks in, either in a friends or family round or what they call these days a pre-seed round. Definitions are a little fuzzy, but usually, your belief capital. You're not traction capital or growth capital because there's not much else other than hope and belief at the early days.
I love that phrase, belief capital. You make me a believer, Ali. Paul, I'll ask you sort of like, how do you see, you've done a lot of angel investing over the years. How do you define angel investing?
I think actually Ali's defined it very well. I think it is belief capital. It is when you find founders who have an idea, they've tested a little bit of idea, probably talking to a lot of friends, a lot of industry peers. They have probably a lot of domain expertise in that space, and they have a hunch of where things are going to go. So I think it's that they're not really testing too much about the business model or the product market fit yet, but they have a good plan of what they think it's going to be. So it's the earliest stage of an idea, actually. So yeah, belief capital is a very good way of thinking about this.
Okay, so now
I didn't come up with this. Somebody on Twitter, somebody smarter than me on Twitter. So
you could. I'm going to attribute it to you anyway because you're here. But so can we put a dollar figure on that though? Like belief is one thing, but is there sort of an expectation around what size checks are written sort of at the angel stage anymore? What are people coming to you looking for? Do they want? I mean, obviously they want as much. I would assume at this stage they're looking for a certain amount of money. But does that usually equate to, is that a $25,000 check? Is that a $100,000 check? Or is it a $10,000 check? Ali, what is that? What is a dollar sign next to belief capital?
Typically for me, it's a 25K check, but 10 to 50 is the typical range. Some people will do higher. And these days, it's possible to do lower now. If you go through syndicates like on AngelList, you can invest as low as $1,000 per deal as well. But typically, if you are going direct on the cap table, generally, 25 is usually the minimum that founders are looking for. Sometimes they'll take up to 10. And I know Paul has done a lot of angel investing. So,
no, yeah, I look at exactly. I look at the same amount. So I usually participate with $25,000. Sometimes you go a little bit larger if you really think this is a great opportunity. It's a little bit more advanced in the thinking. But yes, 25,000 is what I usually come in with. I've done smaller checks, and that's maybe just a function of where the idea is at. But I think it's also important to understand how much money people are raising at that stage, right? Because what you don't want to do is be the only $25,000 into that deal. What you're looking for is for the founders to have enough capital for them to prove out a little bit as a prototype the idea, and you would like to usually see in excess of $250,000 going into the company at that level, at least from my perspective. And yes, it's very different for different industries. So different companies need more capital, some less to prove prototype. But the point is, you just don't want to be that only check or just one of three checks into that company.
Let's explore that a little bit, actually. So is there an ideal number? And I realize this is probably case dependent a lot, right? But is there an ideal number of angels? How many angels is too many cooks in the kitchen? How many is too few? Ali, do you have just sort of a general rule of thumb, or is it really too hard to tell?
I think the problem I would frame it as, is the startup appropriately funded to get to the next milestone? It could be like 3 people, it could be 200, right? Like these days, it's become very easy to get many people into deals, using various tools and platforms like AngelList and Sidecar and Carta and others. The bigger risk is the startup doesn't raise enough capital to get through, like, say, a year and a half, and they are underfunded, and they run out of capital in like 3 months or 6 months, or they're doing like a rolling raise, and some investors have put up money at the beginning, but the startup never manages to raise enough money to kind of get to the next milestone and raise an institutional seed round or an A round.
Okay, so let's Paul, I want to explore that just a little bit more on the other side, right? So you write a check to someone. Typically, what are your expectations? So I'm going to give you a check, right? Now, again, I understand that there are lots of things. You could have 5 angels, you could have 3 angels, and depending on the stage, right? But is there a general rule of thumb for you when you're investing? Like, I'm going to give you $25,000, and in return, I expect, is it, do you just sort of leave them alone to go complete that sort of prototype vision? Or do you have, like, you get, I don't want to say a board seat, right? But you get X amount of the company, or what do you ask in return for that?
No, for me is very simple, and it echoes a little bit what Ali said. For me, when I look at putting money into a company, I want to see a plan. What is the next milestone that they're trying to achieve with the money? And I want to be able to understand that, yes, that milestone will be significant enough so they can actually raise more money as they actually achieve the milestone. If they don't show me that type of plan with milestones that are realistic to achieve and also move the needle and then get other investors excited, then I'm very, very careful. So for me, I have to see like some milestones or where this money is going to get them, and then stretch it out a little bit, right? If they don't meet their milestones, do they still have another 3 or 6 months left of capital to achieve that milestone? So for me, that's what I'm looking. And at this stage, at least for me, I'm not looking for a board seat. I'm here as like support. If the founders need to talk to me, I'm here for them to chat. I'm here to like bounce ideas off. But this is not about control. This is about like belief, is saying you believe in the founders. A lot of the reasons that you invest at this stage is because you like the founders and you believe in them, and they have some sort of competitive advantage that nobody else has, or you're finding diamonds in the rough. That's what you're doing. And you know that they're going to probably pivot 1,000 times before they figure things out. So you're really buying on them. So there's no control. This is not about control. This is just about, hey, believe. You're giving them money, see where it goes.
Ali, I saw you shaking your nodding in agreement, right? And so I want to actually look at that. So when you approach things, are you coming at it more from, you're looking for great founders in your deal? Are you looking for a product? Are you looking at a category? Do you have a general approach when you're going out? Because I know that you do a lot of investing. So is there one thing in particular you're looking for, or one, category, for lack of a better term? Like, are you looking just for like I said before, like a great team, a great product, or a market or a category that you feel like hasn't been addressed yet?
I couldn't agree more with what Paul said. I think at this stage, it's really all about the founders, and you're investing in people. Because the market can change, the product can change. My own experience as a founder doing 3 venture funded startups in the Valley has been, nothing I've done has finished the way it started. right? Sometimes not even in the same market, right? And so like the poor angel investors who invested in me, they get many heart attacks along the way because they don't know what, like, are we going right? Are we going left? Is this river going, east or west? It just, you kind of learn and pick up on signals from the market as you build as a founder. And I think this is true of many founders, right? Very, very rarely something finishes the way it started. So what does that mean for angel investing? It means that the common thread, all you really have to go on is you're betting on people. You're betting on the horses that you think are going to win the race, regardless of what the race is or where the race goes. And Paul Graham, I think, has said it really well. Is if there is one word to kind of sum up what we look for, it's formidable. And different synonyms for that could be relentless, high agency. Someone used this really great phrase to kind of describe a high agency founder would be someone who, if you're stuck in prison in a third world country, who's the first person you're going to call, right, to get you out? Because this person is just going to have to be super, just get it done, figure out a way. And if they can do that, they're probably a good founder. And if not, probably not.
Well, all right. So Paul, can you expound a little bit on like we've got formidable as sort of an adjective here, but is there something in a founder aside from, let's say that, this is angel investing, right? Like, so you might have founders who have a track record, right? So Ali has said that he's, done 3 different, startups back. So you would have some track record there, but is there something you look at from like a first-time founder?
Yeah, I look for people. I mean, there's a lot of things that you're looking for, right? First, you're looking for clear thinking, right? People who think what people have coined like a first principle thinking, that don't get that confused with a dynamic system. They can actually understand, okay, this is how the system works, and why would it succeed. So you have to have some clear thinking around the problem. So you look for that. You look for people who have strong opinions, but like what they say, loosely held, but strong opinions in which, as things happen in the market or in their space, they can listen, learn, and adjust, and then move quickly, right? So I think I'm looking for that too. And another thing I actually look for is, and this goes for any type of leader, people can actually create artifacts quickly. And what do I mean artifacts? I meet a lot of founders who have great ideas and they just talk about it. But the people who can actually say, okay, great, let me put an artifact, let me put a PowerPoint presentation or something that we can all now talk against and brainstorm again so we clarify the idea. I look for that. Can they actually put their thoughts into some actionable path and show everybody how that path works? So if I see founders who just talk and they don't have any artifacts to show, I get a little concerned about that. So I look for people who can like Ali said. So if I'm in jail somewhere in the third world country, I'm in Mexico in jail. It's not third world country. I'm from Mexico, but I would probably call Ali to get me out because I know that he will figure out how to look at different areas and get me out of there. So that's
Thank you, Paul. Thank you, Paul.
But
and likewise.
hopefully I won't end up in jail somewhere.
So now Ali's going to have to think twice before answering his phone. Just in general, let me see if you come up. So Ali, I want to go back to something you said a second ago, which you mentioned, just like heart attacks on the angel investor side, right? There's a saying that happiness comes from setting proper expectations. And so as we're talking to an audience of people who are interested in becoming angel investors or thinking about angel investing, what expectations should they have in order to sort of not have those heart attacks?
The fastest way to become a millionaire is to start off as a billionaire and angel invest. Right? So go the best way to minimize heart attacks is to assume the money is already gone, that you're never going to see a return on it, that you're doing it just for the fulfillment it brings you of supporting founders, getting to see all the cool, exciting things that are happening out there in tech, learning from it, and just the energy of being around people who are optimistic, insanely optimistic about the future and about the world, and are building something new, right? So I think a lot of folks who do get into angel investing are from tech. They've been practitioners either as founders or operators at tech companies, or investors at funds, and they get into angel investing. So that's the first one: is assume you're going to lose your money, right? And be surprised when you don't.
Okay, that's good.
I think if you approach it the other way, it's bad.
What were you gonna say, Paul?
No, I think you have to be a complete optimist when you're actually being an angel investor. You have to look at things like that. And as you're an optimist, you're going to be able to say, look, I'm walking in there thinking, like Ali said, that I'm going to lose all the money, but I'm in there for different reasons. And if it works out, great. But if it doesn't, you really can't take it too seriously. Which actually leads to a bigger point about, like, if you are going to do angel investing, what is probably the better strategy to do, like a portfolio construction and angel investing, right? Because I've learned a lot of hard lessons, doing angel investing and think, oh my God, I'm going to invest in 3 companies and I'm fine. I think if you're going to really do angel investing, you need to think about, how much capital you have to invest in many companies. So at least you have some chance of succeeding at this process.
Let's touch on that for a second. When you say portfolio construction, I can understand those 2 words separately: portfolio, right, and construction. When you put them together, what are you talking about when you mean portfolio construction?
What I mean is that if I look at, let's say I have X amount of capital and I want to get into angel investing. If I say, look, I'm only going to be able to invest, $25,000 on 5 companies. There's a pretty high probability that you'll never see that money back. And because, the probability of success for any startup at the seed level is fairly low. And that's why there's this whole discussion about power law investing, right? That you have to go in and invest in more than 50 companies at a time at that level, so you actually see some return. So you need to start thinking, okay, do I have the capital to be able to invest across the areas that I do want to invest in? Let's say I like AI, but given at the seed level, can I actually get up to 35, 40, 50 investments? So then I'm not dependent on just the success of one, but I have a good portfolio of potential outcomes. If not, you're going to be, you might get lucky. You might invest in Anthropic, and that was your only investment, so that was great. But the probability of going into Anthropic and thinking that one deal is going to make you the money is not going to happen. So I do think you have to sort of do a portfolio construction, meaning, make sure that your portfolio is large enough. There's other parts to that, and Ali can talk about the themes where you want to get involved in and stuff like that. But I do think that you have to at least have a portfolio view of your investments.
Yeah, Ali, we had talked previously to today, and you had sort of a rock hard rule about investing, which I thought was really interesting as it relates to portfolio construction, where you're talking about check size, right? Can you explain sort of your thesis around check size and what kinds of checks you should write?
Always stick to the same check size.
Always stick to the same check size. If you're taking notes at home, always stick to the same check size.
Stick to the same, and there are various reasons for that. One is obviously portfolio construction, right? You can't really have what is a portfolio? A portfolio is sort of risk diversification across many different investments, right? Public equities, we're taught that diversify your risk across many investments. It's sort of why the S&P 500 index is what it is. If you invest lopsided, if you put 500 grand into one deal and 2 grand into all the other deals, it doesn't matter if you have 50 deals, right? So you have to stick to the same check size. That's sort of basic math. Also, I think it instills discipline and prevents you from doing stupid things. I'll give you some personal examples. Some of the worst deals I have done, right? In hindsight, I've done about 80 angel investments personally. And some of my worst investments were where I got too excited by the deal, right? and over invested, like invested more than my check size, and the thing went to zero, right? And so like if it was the fixed 25K, that would have been okay. But if it's more than that, it has a huge sort of outsized impact on the overall portfolio, right? And as investors, we're always going to get excited about deals. That's why you end up investing in the first place. But you get excited by a founder about what they're working on. And so the fixed check size instills some discipline to make sure like you're not, either you don't invest, there shouldn't be like, oh, like I kind of like it a little bit, I'll just put in like 2K, 3K, 5K. You shouldn't, right? If you're not willing to do your check size, don't invest. And never invest more than the check size, because it sort of screws up portfolio construction math. Also don't invest in a deal simply because the terms are good, right? Where you're more excited about the terms of the deal, and this is maybe more for later stage deals, right? Where you're getting a discount or like the valuation or whatever, you feel like you're getting a great deal. Those have also been some of my worst investments.
Got it. I want to talk a
Yeah,
second
and
about.
everything.
Oh, sorry,
Let me add to that. It's like
Yeah.
I see a lot of people coming into the angel investing world, and they think it's like financial engineering, and they start thinking about the deal and the discounts and the rights and so on. I think that's not the right way to do it at all. I think I'm with Ali on this. You are investing in these deals because you believe in the founder, you believe in what they're doing, and you believe that they can actually bob and weave and find themselves out of a bag if they need to. So I think, and it's very easy to get into the whole idea of like, hey, this is a great deal. It's a beautiful discount. I'm getting warrants. I'm getting something. It never pans out.
So let's talk about deals, and specifically sort of deal flow right now. Ali, you touched earlier on syndicates, like it's well-found now. It used to be AngelList. If you're a seasoned angel investor, you probably have a certain amount of deal flow because you have a certain number of relationships that you've done throughout the years, right? And as a starting angel investor, you may not. Are those syndicates a good place to start, do you think? Or what's your advice for someone who's just starting to look for deal flow?
I think so. I think syndicates are great because you can see deals without investing in any of them, right? So you can get free education. You can sort of see 100 deals before you say, I'm ready to develop a sense or taste for what good looks like, what normal looks like, and what bad looks like. Going to demo days and being a part of a bunch of incubators like YC 500, Techstars, and others, and there's like dozens more, especially if you're in Silicon Valley. They're inexpensive ways to get started, right? It just costs you time, not money. And if someone wants to just start out angel investing, they can take, instead of writing 10 or 25K checks in 50 deals, because that amount of capital adds up, you can also just take 25K or 50K total and do $1,000 checks in a bunch of syndicates, right? Just to get started, if you kind of just want to learn and get your feet wet. You could also invest with funds, right? So find a GP, find a fund you like, and they're investing through a fund sort of gives you some of that diversification as well, as long as you believe in the fund manager and the thesis. Yeah.
All right. Paul, do you have any thoughts on that, on finding kind of your first deals and where to go look for them, or any of those, like the syndicates or anything?
Yeah, I think what Ali said, it's all that's what you should do. Just spend time, go have a lot of coffee with a lot of people. It doesn't cost you any money, but you just have to network like in anything. If you really want to understand Silicon Valley, you can't just really do it from, let's say Dallas. You have to come to Silicon Valley and look at deals in Silicon Valley, meet the players, have coffee, go where people are at and have conversations. Because that's how you're going to learn. So it's just the block and tackle of networking. So you want to be able to get into the sort of the tapestry of where deals are happening.
And so let's say you make your investment. Sorry, did I interrupt? I thought I heard something. I don't know if that was a remnant.
Oh no, I was just going to add to that. I think this is probably one of the hardest parts, right? Because the portfolio construction stuff, you're like, yeah, okay, like these are the rules I can follow. But building deal flow actually takes a lot of time and energy, as to Paul's point, like you got to have a lot of coffees, right? And being in a technology hub is a huge advantage. Like you could do it if you're not in a tech hub, but being in a major tech hub is a huge unfair advantage that you get as an angel investor. And yeah, I've also seen you get higher quality deal flow in areas where you have a sort of circle of competence, right, and a track record. So what do I mean by that? My last company was in the creator tools space, right? Live streaming, Twitch, YouTube creator tools, and we exited. And because of that, I get deal flow, and I get to meet founders who are, pre-IPO or doing really well or raising rounds, all the way from sort of pre-seed to pre-IPO within that vertical, because that's where I spent a lot of years and built a startup, right? I don't get that in AI. I don't get that in like prop tech. I don't get that in space tech, right? For example. So understanding your own sort of circle of competence and where your brand and your experience and your history brings advantages will help you get much higher quality deal flow in certain areas versus others.
So, okay, so let's say you've gotten a deal. What's the timeline for any kind of return that you might see? Paul, I'm going to start with you. Are we talking like 10 years, 5 years? What is it? I don't know if there's a typical number, but is there something to where you invest on today in 2024? When would you assume that you might see something if something were to happen?
I'll just give you my general rule of thumb, which is there's a reasoning behind it, but it's not super solid. I put 10 years. My view is when I put money in is I think I'll probably see a return within 10 years. I think I'm one of the first money into the deal. I think they're going to have to like figure out what the prototype is, what the market fit is. They're going to have to raise money, go to market, and so on and so forth. So I think at least it's a 10-year horizon. I've seen deals in which you come out after 3 years. One of the companies that I founded, AI Reverie, we got acquired within like 4 years, but that was abnormal. That was not like the normal path that people would follow. So I put a 10-year horizon and hope for the best at that level.
Yes, understanding, Ali, that what you said earlier is just, kiss the money goodbye anyway. But are you in that sort of like decade-long time span for any sort of return?
Yep. I think you're investing at pre-seed or seed, you have to be. That's the duration.
Okay, excellent.
So if you're 90 years old,
yeah, maybe don't do it all in that time frame. So
or do it through a trust for your kids.
Exactly.
Oh, that's interesting. Ali, we talked previously about different ways you can structure sort of how you're investing. Can you walk us through a little bit of that? We don't need to get too far into the weeds in terms of tax sheltered kinds of things, but I think a lot of people may think, oh, it's just, what's in my checkbook or whatever, but you have other alternate methods that people may not be aware of. And this is not financial advice by any means, just a blanket statement. This is not financial advice. This is for entertainment purposes only. Anyway, Ali, with that, like what are some of the things that you have that can be explored?
This is not financial advice, and Paul, feel free to chime in. I'm sure you've gone through some of this as well. But there are tax advantages. So angel investing is tax advantaged, at least in the US, the UK, a few other countries. Similar to real estate, right? So like if you're in real estate, if you spend a certain amount of time, I think there's a bunch of requirements, but if you're a real estate professional, you get accelerated depreciation and a bunch of tax benefits, right? Similarly, in angel investing, you have various things. So QSBS is probably the big one, right? Where the first $10 million in gains is excluded from federal taxes per investment. Now, that was originally intended for founders, but it also applies to angel investors, right? So for founders, like you start a company, you sell it, great, the first 10 million is excluded from federal taxes, cap gains, or income, right? There's no tax on the first 10 million. That's great. But for angels, it applies to each investment. So you have a portfolio of 50, and maybe you get a return on 3, like 3 of them make money. It really helps, like if there's no federal taxes to pay on those 3. People also use trusts to transfer shares when they are undervalued or very early on to their kids, right? As a way of bypassing or reducing inheritance taxes and state taxes. There's a limit on lifetime giving when people are setting up trusts and states. It's sort of a longer conversation. There's QSBS stacking, where people use multiple entities to kind of add the 10 million plus 10 million plus 10 million for like your kids, for example. Each of them could have their own trust with its own $10 million sort of exclusion. So if you've got a company and say you're a founder, or you've got a startup in your portfolio that's doing really well and that is probably going to exit, and it's just around the corner from an exit or an IPO, that's one thing people could use QSBS stacking there. Paul, anything else? I've thrown
No,
out a lot
I think
there.
you've mentioned most of them actually. I think QSPS is extremely important if you're a founder, and I think you need to make sure that you are doing that correctly. And also, there's a 5-year holding period for QSPS. It's super important, because what that means is that, as Ali said, if you hold something, the first $10 million of profit on your investment is tax-free from the federal side. But you should have held that investment for at least 5 years. If you don't hold that investment for 5 years, you don't get that benefit. So even if you held it for 4.9 years, you don't qualify. There's different things that you can do, because it can take the proceeds and invest in another QSBS, and there's different things you can do around that, but that gets complicated. One thing that you didn't mention, I've looked into it, but I have yet to do this, is investing in your founder stock with a Roth IRA. And Peter Thiel has taught us, I think.
Yes.
I don't have firsthand experience on that, but I've read. But it's not as simple as people think it is. But yes, that's like a way to like really avoid a lot of taxes. If you have a company that becomes a unicorn, you're not really paying any taxes. So those are the things. But you've mentioned all the other stuff that you should look into.
I want to open this up for questions from the audience, so you can submit a question and I will pass it along if you have any. Paul, I want to get, actually, while we're getting kind of nuts and bolty here, I want to get really nuts and bolty with you here real quick, which is just on a basic level. If people are getting interested in angel investing, do they need to set up their own corporation? Like, is it a separate bank account? Like, are there some basic nuts and bolts things, or am I just literally writing a check from my personal bank account?
Well, you can do it however you want to do it. You can write it from your own personal bank account to be held individually with you. If you're married and have children, hopefully you have some sort of trust, so you're running at least under the trust name, so for probate issues or anything to that extent. If you want to be able to show that you have a track record on your investments, I would almost say, create some LLCs. You want to create a management LLC, a GP, and an LP, so you can actually create a whole ecosystem around your entity, so you can actually warehouse your investments there. And that's important, so you can actually track your return, because what you want to be able to do is say, hey, I had this return and it's auditable. But that's only if you want to start showing that eventually this is your first step to eventually raise outside money, so you can actually do more fund investment, because you do want to show that the structures are clean, and also that the record is there for you to show. So there's many different ways for you to do it. But if you are serious about being an angel investor and eventually you want to raise outside money to do more of that at scale, I would almost say think about getting a lawyer and creating a structure around that with LLCs. Ali, jump in if you
Oh.
think it's a little different.
Yeah, agreed. Agreed.
Okay, so as we sort of wind down here in this talk, this has all been super fascinating. Thank you both so much for being a part of this. But one thing I want to make sure is that we leave people who are watching with like a definite something that an actionable bit of advice, right? Like a lot of times you sit on these webinars and they're like, oh, you know, dream big and believe in yourself and all this, right? Like, I don't want to. What we're looking for is like, what's one thing people can do upon listening to this that can get them at least going in the right direction, whether that's a book to read, a newsletter to subscribe to, someone to follow, right? Like what's one actionable item people can take today to begin an angel investing journey? Ali, I'll start with you.
In terms of something to read, geez, I'm trying to think, is it better to give people something to read or watch or do? And I'm
Or
going to
both.
pick do.
Yeah, whatever you want.
If I had to pick one, I'd pick do. So I would go and sign up to attend a demo day from your favorite accelerator. Could be YC, could be 500, Techstars, some are easier to get into than others. Find the best one you can get into and go to the next demo day and go watch 30 pitches, 40, 50, 100, whatever they have. Sit through that experience. I think it is the fastest education you can get in a day or two.
Okay, so so those are, people can just go find a demo day on YC Combinator or 500, I can't remember the name of it, 500 startups, and just attend the demo day. They don't have to, there's nothing, they don't need any sort of credentials or anything to be there.
You need to be an accredited investor. So they're going to ask you a few questions about income and net worth and whatnot. And YC typically is harder to get into. You need to have a bit of a track record, get referred in by a few people, but some are easier than others, right? Like my point being, there's over 500 accelerators in the US alone, startup accelerators, and you should be able to get into most of them. So it's as easy as just, picking Techstars or 500 if you can't get into YC and just go to their next demo day.
And this is just where people line up, all the founders line up and show off their product throughout the day, just one after another.
And they're just pitching. Yeah. I mean, they're doing like 2-3 minute sort of bullet pitches all day long. Dozens of startups.
Excellent. Paul?
Yeah, for me, I'm going to go back to something that I talked about earlier on. I think go out and really understand power law investing. It's super simple, but actually read a lot about it. There's a lot of modeling that goes on that showed what that means to do power law investing. There's a good article, it's called The Tale of Two Squirrels, that people should read and look into. But because one of my greatest mistakes has been not increasing the amount of deals that I'm doing. So and not keeping this, like what Ali said, making sure that's the same dollar amount every time I invest, because I think I sometimes went a little too high in my dollar amount. So I would really understand power law investing, because that's how what you want to make sure as when you're just starting this, that you have a great experience and you succeed a little bit. And what power law investing does, it gives you a really nice portfolio distribution of deals. And the probability of you at least making your money back is higher than if you start like really going big in few number of deals. So I would just tell people, go look at power law investing.
Excellent. Well, that's really great. Ali Moiz and Paul Walborsky, thank you so much for enlightening us today and giving us your thoughts on getting your angel wings. We really appreciate your time. If you're sitting at home, please give them a round of applause and thank you. I wish I could simulate the applause noise for you so that you knew how appreciative we are. But this has been great, really. Thank you. And everybody, this is just one in a series of OpenWater events that we do. We'll have another one next week. You can visit openwater.group/events, and you can see our full calendar there. Thank you, Ali, and thank you, Paul.